Well, I think this is going to make the Fed's job more difficult, because the longer it takes for the labor market, for the consumer to show that needed weakness or respond to earlier policy tightening, the more aggressive the response from the Fed must be, thus ensuring an eventual downturn. So the notion that the fact that consumer has continued to be resilient across the first 525 basis points, supporting the notion of a soft landing, no, I would argue it's quite the opposite. That simply means the Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer than investors had anticipated, suggesting that the downturn potentially and eventually will come and may be more aggressive, more of a downturn than previously anticipated if the Fed didn't need to raise rates quite as much to squash out inflation.
Lindsey, you said two things: raise rates higher and keep them there for longer. And those were the ideas that people had. But some people are starting to think, okay, what if the Fed is done with how high they're going to raise rates, but they are going to keep them there for longer? And that's what we're seeing priced into the market gradually, with some of the highest longer-term expectations for Fed funds rates that we've seen in this cycle. At what point does that cause more damage in your view?
Well, I think it's certainly going to cause more damage. Again, the more pressure on the Fed to respond. Now, if we continue to see this type of resilience, if we continue to see third quarter GDP surpass earlier expectations or surpass what we saw in the second quarter, I think the Fed doesn't necessarily need to continue to raise rates indefinitely. But once they reach that sufficiently restrictive level, as you mentioned, we've long conceded that will be 6% or above, the Fed is likely going to be forced to keep us at that elevated level for some time. The Fed itself has said rate cuts are not in their base case scenario for 2023, but even 2024 remains a sizable question mark if we aren't able to see that intended result. Remember, the Fed is raising rates to tap down consumption, tap down investment, and result in a slower level of activity in order to get that more benign inflation. But thus far, the economy is pushing very hard against the intentions of tighter monetary policy.
If you are just joining us, we are just seeing the ramifications of retail sales numbers that came in significantly higher than expected. We're seeing the overall month-over-month headline number of 0.7% versus expectations of 0.4%. The control group, which does factor into the U.S. gross domestic product figure, came in at 1% from the expected 0.5%. We are seeing two-year yields surge past 5%, 10-year yields and 30-year yields both reaching the highest level since October, climbing up. We're seeing 30-year yields 4.32%. Lindsey Piegza of Stifel with us. And Lindsey, I really want to get your sense of what could potentially halt this spending. You were saying it can't persist. You're not going to see this forever. Some people have pointed to the student loan repayments that are going to restart in October. Do you give credence to this sort of idea that we could see some sort of tightening and fiscal tightening on that front going forward?
Oh, absolutely. There's a number of factors. And remember, even with this monthly increase, beating expectations, when we take a step back and look at the longer-term momentum, it's very clear that consumers are beginning to slow their activity. Coming out of the gate from the great the shutdown, we had a double-digit growth. Then we slowed to 8, 6. Now we're talking about bouncing around 2% on an annual basis. So while still positive, the consumer has clearly pulled back. And these other factors, as you mentioned, monthly payments for student loans, additional housing payments coming back online. This is going to compound the pressure on the consumer. Now, there are some temporary supports that we're still tapping into. There still is a sputtering of state and local stimulus. Consumers are turning to 401ks. Consumers are ramping up credit card debt. And with the relative health of the balance sheet, meaning we paid down debt during the closure, during the pandemic, there still is some wiggle room for the consumer to expand that balance sheet. So I'm certainly not suggesting that the consumer is going to immediately fall off a cliff. But what we are seeing is these indefinite supports beginning to wane, putting additional pressure on the consumer eventually as we head further into the second half of the year.
What do you expect Jay Powell to say in Jackson Hole next week, given all of this?
Well, I think one of the biggest questions that investors have is for how long? And that's really what I think Chair Powell is going to focus on. It's not necessarily how high, because it seems as if the committee is of one mind that we're nearing that terminal level. Whether it's 1, 2, maybe even 3 additional rate hikes, we're up near that sufficiently restrictive level. But how long will the Fed need to raise rate or keep rates, at that elevated level? I also think he's going to talk about the context of inflation against monetary policy. How does the Fed respond if we see a reversal in inflationary pressures? Is that even a scenario that the Fed is considering? And how does the committee balance the risk between raising rates even higher than previously expected, slowing the economy, against the risk of wanting to obtain that 2% inflation target? So there's a lot of questions that investors are going to be listening for, that I'm going to be listening for, in terms of how to gauge the Fed's mindset on these broader themes for inflation and monetary policy.